So, hello everyone. Let us start with the topic of financial accounting. Today we'll understand about the definition of financial accounting because in the last lessons we have studied about the terminology of accounting. Those are the very basic terminology which is used in financial accounting. Today we'll understand the definition of financial accounting, and I've divided this definition into four parts. So we'll study each of the four parts, and when these four parts are clear to you, that means the definition is clear to you. Now next we'll study about the financial accounting. Let us study with the, now this is a definition I'm providing you because if in exams sometimes these questions come in the form of 2 marks also, and sometimes they come in the form of full-fledged question like what is financial accounting and what are the objectives of financial accounting, define financial accounting. Okay, so these questions can be these are the very well prepared answers if you want to write in your exam. Okay, now, what it is that branch of accounting that keeps a track of company's financial transactions. Now, what it is saying that branch of accounting. What is the meaning of branch of accounting? That means the other parts of accounting also available in here. That is, you have cost accounting also and management accounting, which are other two subjects of accounting. Okay, so this is the very first part we are studying financial accounting. That means this accounting deals with the company's financial transactions. That is the financial activities or the events which are taking place in the business on day-to-day life. Now, American Institute of Certified Accountants 1941 has given you this definition of accounting. Now, if you write this particular thing, American Institute of Certified Accountants, it gives a very good impression to the examiner also that yeah, you are very well versed with the definition of accounting. Okay, so wherever the definitions you try to write in exams or something, always make sure that you write the proper definition which is given by the particular author. Okay. Now, accounting is the art of recording. Now, we are dividing this definition today in four parts. First is recording, the very first part. This is the process of accounting, basically, you can say. This is how accounting is done. Recording is done, then classifying is done, then summarizing in the form of financial statements, and then analyzing and interpreting and communicating the results to the users of that information. This is the fourth part. So, there are basically four parts, steps of accounting in financial accounting. The four steps it is telling you that what is the meaning of accounting. That is recording, classifying, summarizing, and interpreting and communicating. Okay. American Institute of Certified Public Accountants changed the definition and said, this is another definition. It is to provide the quantitative information. Now, if you write this definition, it is basically called the incomplete definition. So always make sure either you write this definition in your exam or either you can write both the definitions. It gives a very good point to the person that you have the fair knowledge of accounting definition. Otherwise, write only this one or write both of them, but don't write only this single one, this quantitative one only, because it doesn't give a fair idea of financial accounting definition, because it seems that you don't have the very full knowledge of this definition. Now, it provides quantitative information, primary financial in nature, about economic entities. That what does it mean? Quantitative information means it is basically dealing with the transactions which are measured in terms of money in quantity or in numbers. We have discussed this in the lesson of transactions, okay, in the terminology of accounting. So that means it is avoiding the qualitative information. Okay, that means it is avoiding information like such as skills and development and efficiency improvement of the employees or the technology updated in the company. Means any other thing which cannot be measured in terms of money will not be recorded in financial accounting. That means only the qualitative information, quantitative information is recorded, not the qualitative information. Though it is affecting the company also, it is affecting the company, goodwill also, benefits also, but still it is not being recorded in financial accounting. Okay, so it is also one of the drawbacks of financial accounting. Now, economic decisions means obviously it helps in making economic decisions because you have a world of choices, but you have to make limited. You have a lot of choices. Economic decisions means you have a lot of choices, but you have limited resources. Okay, so you have to make a choice with limited resources. Okay, so that does it mean that suppose you want to buy a gadget. Suppose you're talking of any business or a company, you want to buy a gadget or any appliance or any machinery. Okay, now you have to buy it at a certain price. Is it fine, right? That means you have to see whether it is worth investing or worth spending that much money in that gadget or asset. Okay, so this is called financial or economic decision. which you have to make with the help of financial accounting. So because if you know have the fair idea of the company's profit and loss, you have the fair idea of your resources being at your disposal, or you know that whether the company is sustainable in future or not. So depending upon these factors, you take a decision whether to invest in a particular asset or not. Okay, whether to make investment or not. So any economic decision has to be taken because you have limited resources, but you have a lot of choices. But you have limited resources, so that is why to make a choice with that limited resources, this is called economic decision. Okay. So now we understand about, now this is very clear blueprint. I have given you the definition, so you can never forget the accounting definition. When I say the very first step, it is recording. Recording means journalizing. You are making a journal. When I say classifying, it means you are posting from the journal into the ledger. The transactions or entries you have made in the journal, you are posting into ledger. The third step is summarizing. Here you are preparing the financial statements. Financial statements give you the idea of what the company's liquidity position, what the company's profit or loss, and what is the company's sustainability in the future. And basically whether company is able to meet its day-to-day expenses or obligations or not, whether company has enough assets, okay, whether the company is actually making a impact or creating a market share. Okay, so basically it gives a fair idea of the company's financial position. This is income statement, balance sheet, profit and loss account, your trial balance, everything. Okay, now let us stay interpreting again. Analyzing the financial position is the fourth step. The last step is communication. So that is internal and external users of information. External and internal users means if you are doing any business, that means you have certain persons or certain individuals involved in your business. That is the internal users, like your employees, your managers, your shareholders, owners. They are your internal users of any business. External users means your creditors, your suppliers, your lenders, banks, financial institutions, etc. So we have divided this definition into 5 parts: recording, classifying, summarizing, interpreting, and communicating. Now you can say R, C, S, I, C. You can make any word out of it, like this is R, then this is C, this is S, and then you have I and C. Now you can make any word out of it and just try to make and remember this definition in a sequence. Okay. Now this is the definition of accounting. Now different authors or different people, they have their own definition of accounting. The very basic definition I have told you, the very first one, which you should always write in your exam to give a good impression to the examiner. And the next important thing is, if you actually try to elaborate it or demonstrate it with an example, it gives again a very clear picture to you, okay, and to the examiner. Now see the three activities of accounting. Identification. Now this is very basic, I am telling you. This is again the same thing only, but in a different demonstration. Okay, identification, then recording, then communication. Okay, so identify means, now let us take the example of a garment business or electronic business I'm talking about. Okay, let us take example of grocery store. Now in a grocery store, if you are maintaining your accounts books, okay, so you suppose a grocery store name is Reliance Fresh. That is your ABC company I'm telling. Okay, now in this ABC company, what are the financial activities? Because the very first step is recording. So here in this business, what I will identify, what are my financial transactions? What are the financial events happening in my business? What can happen in a grocery store? What financial transaction can happen in a grocery store? Selling and buying of the food products, then paying wages or salaries to the employees, okay, or paying the rent of the store, okay, so this, or paying the income tax. So these are the very basic things which I'm talking of. This means identifying means you're selecting the economic events, that is you're identifying what are the transactions happening in my business, and only those transactions which can be measured in terms of money I will be recording in my book called journal. Okay, so this recording is done in journal, the very first process of your accounting. Okay, now journal. Now second step, when once the things are recorded in journal, now what is my next step? I will classify and summarize. That means now classify and summarize means now I will record them, then segregate into different accounts, and then I'll summarize in my financial statements. And ultimately, I'll prepare my financial statements like income statement, your profit and loss account, your balance sheet, your trial balance, everything will be prepared. And then I'll analyze this financial position of my company, and then I'll interpret it, and then I'll communicate this results to the users of financial information. The users I've explained you already, that is creditors, lenders, banks, financial institutions, owners, managers, shareholders. Okay, employees also, you're right. So bookkeeping process includes the accounting process includes the bookkeeping function. Now what is the meaning of bookkeeping? Now it is a separate question also comes in this form, like what is accounting, financial accounting, and what is bookkeeping function. So this is also a very important question, but right now I'll give you a brief idea of what is the meaning of bookkeeping. Bookkeeping just means making records of something. That is just making the records. Okay. But accounting, do you think really accounting is only bookkeeping function? No. Accounting is not only making the records, but still classifying it, summarizing it, analyzing it, preparing reports, interpreting it, and then communicating it to the users. That means accounting includes this function of bookkeeping function, but it is not the only single function. Okay, it is including this bookkeeping function, that is making records, and it is doing much more than making the records. So this is a very good demonstration which is shown here. You can also if you want to include it in your answer anyway, how in exams or something, you can just have a picture of it and try to put it in your answer. Now, let us start the more detailed analysis of what is the meaning of recording. Now, I told you my very first step is recording. But actually, you can also say identifying and recording. You can also include in your first step is identifying and recording. Here I have written recording. You can also write identifying and recording, and or you can say journalizing. Okay, they all have the more or less same meaning in accounting. Now, journal is the word derived from the Latin word journ, that which means a day. That means whatever is happening in a day, they are recorded in journal. Latin word journal. Now, therefore, journal means a day book where day-to-day transactions are recorded in chronological order. Chronological means sequential order, day-wise and date-wise. Okay, and even chronological means much more than that. It means everything in a sequence, in an order, and with date proper, with proper timing, with proper day also. Then process of recording the transaction in the journal is called journalizing. So when you write the transaction in the journal in a book, it is called journalizing, and whatever entry you made in the journal of that transaction, it is called journal entry. Now, any information recorded in the journal is known as entry. When I say I am entering the transaction in the journal, I am making a journal entry. It means I am writing that transaction into the journal. Okay. Now, when we say financial accounting, we always mean double entry accounting. Now, double entry means where we are making a record of debit and credit side of a transaction. It means whenever a transaction happen in a business, it always affects two accounts. So one side is debit side and other side is credit side. Okay. And the most important thing is all the debits equal to all the credits. This is a very important formula of financial accounting, that all the debits should equal to all the credits. Now this you will understand, we'll come to the practical questions. So currently you just understand a very simple thing, that all the debits equal to all the credits in a transaction. Okay. So very first step is clear, that is recording or journalizing or identifying and recording. Now let us see how the picture of a journal looks like. You have a date over here, you have particulars over here, then you have ledger folio, debit side and credit side. You always write debit in the form of DR and credit in the form of CR. And whenever you, now this entry I'm not teaching you right now, I'm not letting you know what it is right now. Just I'm telling you, suppose any transaction happen in a business, suppose a salary being paid to this person. Okay. Now when salary is paid to this person, what I will write in my books of accounts, I'll start making a record in my book, which is called journal. And I'll start with the date over, suppose I write the date over here. Then I write the name of the person and the cash given to him. And whatever the amount is written in the debit side is equal to the credit side. So this is the meaning of double entry bookkeeping system or double entry financial accounting, double entry accounting. Okay. Now whatever this particular line which I have written in my bracket, in the bracket open and close, here I am doing, see the brackets open and close, it means this is a meaning of the transaction which happened in the business. I'm writing it in the form of narration. So this is word means that is whatever entry being made is written in the form of narration. Okay, I'm writing it that what exactly is this transaction is about. So this is called narration. That means you always start with a bracket and close it with a bracket. Okay, so that means whatever has happened in your organization, whatever transaction took place in your organization or in your business, you write in the form of narration along with the journal entry. Okay, journal entry means whatever I'm writing in my books of accounts in the form of debit or credit, that is called journal entry. So we'll start with the ledger now. Now, what is the meaning of ledger? So the meaning of ledger, the second step comes is your classifying step. Now, once I've written everything in my journal, the only the transactions part, okay, I will classify them into different accounts. Now, what is the meaning of ledger? Ledger is a principal books of account. The very first book was journal. The second book, there is a principal book, or you can say the final book of accounts. It is called ledger, in which the transactions of similar nature are recorded at one place, and or the transactions relating to a particular person or thing are recorded in a classified form. We will understand it with an example. It is also called the journal ledger, or the ledger is a book in which the accounts, all accounts relating to the business enterprise are kept. Now, what does it mean? See, I told you right now, all the transactions happen in a business, they are recorded in journal. Now, all type of transactions means we are maintaining all types of accounts. There may be cash account also, sorry, there may be cash account also, or there may be sales account also, or there may be purchase account also, or there may be, uh, accounts receivable account, or there may be accounts payable account. That means here there's so many accounts are being prepared in a ledger. That means all these accounts, all the transactions of similar nature are recorded in these accounts. Okay, you understand with an example. Now see, we are making these many types of ledgers. We are making asset accounts, asset ledger like prepaid expense ledger, cash account ledger, then account receivable ledger, then accounts payable ledger, okay, then debt ledger, then notes payable ledger, then we are making revenue account, expenses account, like expenses like rent account, income tax account, okay, then equity accounts, that is your capital account, then your profit and loss account. That means you're making so many accounts, and these are all in a classified form. That means they're segregated. All the transactions of similar nature are recorded in one particular account. Like say suppose all the transactions of cash in cash account, all the transactions of account receivable in account receivable account, all the transactions of accounts payable in the accounts payable account. Now let us move on further. Now we'll start with now ledgers. We can understand ledger in a much better way. Now you can see over here, this I have taken the ledger example. Cash account I have prepared, okay, and this cash account shows now what is the format of a ledger. Date you write, then descriptive, that is particulars, then reference number, that is from the journal, okay, because you're transferring the entries from, you're posting the entries from journal to ledger. So this is called posting. When you transfer the entries from journal into a ledger, it is called posting, and reference number from a journal is taken, okay, then amount, then again date, then again particulars, that is description, and then reference number, then amount. So this side is your debit side, this is debit side, and this is your credit side, okay. So what does it mean? That means this is both, again all the debits equal to all the credits, okay, and whatever I am writing over here, these are first all the entries being written in the journal, then now I'm transferring it all into different accounts, cash into cash, all the transactions in cash account, all the furniture account transactions in furniture account, okay. This is what is ledger. This is a format of a ledger. Now you can see over here ledgers. Now this is a classified accounts, because they all the transactions similar nature recorded in the that particular account, like cash into cash account, all the furniture transactions in furniture account, all the debtors transactions in debtors account. So this is a classified form, okay. And secondly, first thing classified form, secondly is all the transactions similar nature recorded at one place, and lastly is this is a book of principal account or final accounts or secondary book. books of accounts. Okay, so they contain detailed transaction information for one account. Now this is clear, one account, because transactions of similar nature into one account, one type of transaction, or in the case of journal ledgers, summarize information for all of a company's financial transactions over a period of time. So that means it gives a detailed transactions view over a period of time. Now, if you can see over here, I am balancing it like 90,000 here and 90,000 here. Debit side also 90,000, credit side also 90,000. That means here in the ledger, balancing is done. I am balancing the accounts with the number like 90,000 this way. I am balancing, and 90,000 this way I am balancing. That means balancing is done in the ledgers. But you saw in the journal format, no balancing was done. Okay, so whenever you write the entries in journal, it is called journalizing, and whenever you post these entries into the ledger, it is called posting. Okay. So one most important thing is that when you prepare this account, you always see some balance remaining of this account. That means this much cash is still remaining in the company. So write in the form of balance CD, it is 36,000. Okay, this is the amount which is remaining. Okay, which is to be transferred now. This much cash is still in your business. Okay, if you come to furniture account, you can see over here the company has that much balance remaining. That is 20,000 still remaining. So this is called your balance, which is to be transferred to some other account. Okay. Now, if you can see over here, owner's equity account, another. So these are separate ledgers prepared for each account. Okay, so that means separate ledgers are prepared for all the types of accounts. Okay, and they are in a classified form. Here, balancing is done for all the ledgers, and whatever the balance you have remaining, that is also transferred to again to the trial balance. Okay, if you can see our owner's equity account, here balance CD is 1 lakh. That means this much is amount will be shown in the owner's equity side of the balance sheet or trial balance. Okay, if you can see over here account receivable, then again separate account is prepared for account receivable. That is, you have your balance of I think there is no balance now, so no balance CD is written over here. That means no balance remaining. That means the debtor has paid the full amount to the company now. Okay, that means balance over here, see 12,000 here also balanced, and 12,000 here also balanced. That means whatever is the debit side is in the credit side. Okay. Now, let us come to the third step now. The third step is making the financial reports. Now, what can come in the financial statements? We discussed about the financial statements. Financial statements, again, I repeat, they are the statements which let you know about the financial position of the business, the liquidity position of the business, the profit and loss of the business, the sustainability of the business into the future, and also let you know about whether the company has enough assets or enough cash to meet the day-to-day obligations. Okay, so this is trial balance is prepared, then balance sheet is prepared, income statement is prepared, profit and loss statement is prepared. Now there are so many statements are prepared. I am discussing only four major ones. Now let us see what this trial balance shows you. Now I told you, if you remember in the ledger part, I just now told you that you write some balance CD over there, or balance BD is written. Okay, so this balance CD tells you about the amount which is related to that particular account. Okay, suppose the cash in the balance CD account was 36,000. So that cash amount will be transferred over here in the debit side or the credit side depending upon the balance. You write over, if it is a negative side, you write over debits. If it is in the positive side, that means it is still with the company, then you write in the credit side. Okay, so that means whatever cash is there, you write in the trial balance. Whatever amount you have prepared in the ledger, whatever ledger account you have prepared of the cash, that balance of the cash will be transferred in this trial balance, either on the debit side or the credit side depending upon the ledger. Okay, balance. Now account receivable, so whatever accounts you have prepared of the ledgers, all the ledger accounts, okay, having debit and credit balances, they will be written over here in this trial balance. So this trial balance should also be equal, all the debits equal to all the credits. So this is very interesting part of accounting, because I like accounting very much because of this concepts. Because if you can see over here, it is a very important criteria to understand that all the accounts of ledger which you have made are transferred to now trial balance. Okay, this is your financial statement. Basically, this is your financial statement. Trial balance is your financial statement. So whatever you have prepared the ledgers, you are transferring into now into your trial balance. And whatever amount is written in those accounts, like accounts payable have, if the credit balance, you write the credit side. If notes payable has the credit balance, you write the credit side. If you have services revenue, you write in the credit side. So whatever you have, depending upon the debit or credit balances, you write in the respective sides. So you can say trial balance is an internal report that lists each account, okay, name as well as a balance, which is documented within the journal ledger. Now you understood this line, okay? It provides a quick view of which accounts have debit and credit balances. So this also we have discussed right now, okay? Now let us come to the balance sheet. Balance sheet means again which shows you the assets of the business and the liabilities of the business. What the company owns with it and what the company owes to others. Okay. Now we have also discussed assets and liabilities in the previous lessons. So you can refer to those videos. And next we have assets. You can see in the asset side you have so many of the assets: property, equipment, land, building, equipment, then goodwill, trade names, then you have properties, you have prepaid insurance, you have supplies, you have inventory, account receivable. These all are your assets. Your debtors all are your assets. If you see in the liability side, you have wages payable. That means wages to be paid to the employees, salaries outstanding to the employees. Then unearned revenues, notes payable, long-term liabilities, accounts payable, taxes payable. So these are your liabilities of the business. That means this much amount is to be paid. All these amount has to be paid to the third party. The company is not liable to make a payment to others. Okay, and here what the company owes with it. Okay, so all the things. If the company has more assets, that means the company is still sustainable in future. Okay. Now let's come to another financial statement, profit and loss statement. This very purpose of profit and loss statement is to ascertain whether the business is making profit or loss, and also it reveals the money spent or cost incurred in an organization's effort to generate revenue, representing the cost of doing the business. That means the expenses also and cost also are shown in this statement, and ultimately your gross profit and net profit are available to you. See, gross profit can be seen and net profit can be seen. That means depending upon this gross profit and net profit, you can come to know about the current financial position of the company as well as the current liquidity position, whether the company is in such a state to meet its day-to-day obligations or expenses of the business. Next, you come to have now you have income statement. Now, don't confuse yourself with so much of the examples you are able to see now, because this I'm giving you just a brief idea of what is accounting, okay, and how interesting it is. That is why I've just tried to create an interest in you so that you can actually have a fun learning with it. Okay, so that is why I'm just trying to demonstrate it with a with this practical example. So you don't have to learn all this, you just have to understand that for the definition part I'm just trying to let you know that how interesting accounting is. Okay, now income statement is basically income statement shows you about the revenue and the expenses and the net income of the business. Here I'm talking about the income before taxes and after taxes also. Now, what are the users? Users accounting information, internal user, external users. Internal users means who are actually running the business, like owner who supply capital to the business need to know how much income is earned by using their funds. Now, they only invest the amount into the business, so they're interested that how much income will be earned if they invest their funds into the business. Employees need to know whether they will be getting the good salary or not. If the business is stable and profitable, obviously they will be getting good hikes also. Management is important because it is responsible for improving the organization performance and position and taking appropriate measures to improve the company's results. So if there is any deviation in the standard performance of the company, deviations in the performance of the business, they will take actions to control the activities of the business and ultimately take a decision. They analyze the financial position, they analyze where the company's which factors the company, what are the shortcomings of the company, what are the different where the company is lacking the performance. We also find out the strength of the business and what are the areas and also the areas where the company is lacking the performance, and will they improve the efforts to Paki, where the companies identify the organization's performance and where it is lacking, and also will understand where we take the appropriate measures where the company is deviating from its result, appropriate measures to improve the performance of the business. External users means this, like suppose who want to invest in your business, like suppose you have your lenders, there's banks who cannot give you, they won't provide loans to the business if they believe that the financial position is not good. If the financial position is not sound, they won't give you loans. Then creditors, basically who give the goods on credit to the business, they will need to know whether they'll be able to pay the amount in time or not. Then customers need to whether they can depend upon the business concern for supply of the goods over a long period of time, whether there will be accessibility of the goods for a longer period, whether the goods will be provided to them for a longer period. That is, need to know whether they can depend upon the business concern supply of the goods over long, whether there is stability in the business. That is they're important, because if the loyal customers are more interested in the stability of the business. Then government needs to know how much taxes they should be paid, how much taxes should be charged by the business depending upon the profitability. And local public need to know whether the whatever business they are in, that should not create hazards for the society, as well it should not become a restraint for the development of the community. It should not create a restraint. It should not contain. It should not restrain the local development of the country. You should not restrain the local development. So that is, you should not provide those, you should not create such products which are hazards for the society, and should also not create should create more involved in the environmental friendly products. Okay. Now this is a very last thing, which is a very important question which can come in exams regarding journal and ledger. It's a very, very good question. It is a book of primary entry. Obviously the very first recording is done in journal, and the last entry is done in the final in the ledger, because here the segregation part is done. Then primary documents like vouchers, the bills, receipts, they are a basis of recording the transactions in the journal, and the basis of recording transactions in the ledger, because from here the transactions will be recorded from journal to ledger. Now, recording in the journal is the first stage and is the second stage. They are chronological. They are see the net effect of transactions depending affecting the particular account. Then they have this format. They have this format. This is not balanced, and they are all balanced. Obviously, the process is called generalizing. The process is called posting. Then the service a basis of operation of financial accounts, final accounts. This is your profit and loss account, balance sheet, and all those things. This serves as a basis which I have given you. Now this is again, now this is the final crux of our lesson today. This is a crux of our